Just high level, who here, just to get a feel, who here meets with their accountant like throughout the year to actually run your numbers, do something about your taxes, and lower it? A few people? Okay, awesome. So hopefully everyone's hand realizes why they need to be up by the end of our time today. But the IRS really has two tax codes. So there's a tax code for employees, and then there's a tax code for business owners. The tax code for employees kind of has one correct answer. Yes, you can buy a home to write off some mortgage interest, give money away, et cetera. But for the most part, your tax bill is what it is. On the business owner side of things, there's so much you can do to actually lower your taxes. Literally, the tax code is so thick that if I printed it out and held it in front of me, Court, you could stand across the room and fire a Colt 45 Magnum at me and it wouldn't pierce through. And 90% of that is for business owners. And so, what's that? You want to try it? We got a printer. We got some photo. I might need some more paper. But so most business owners don't realize that, and so they only meet with their accountant at tax filing time. Like we just had, everyone just cut their big check on April 15th. So just high level concept is you want to do tax planning with your accountant, not just fill out the forms at tax time, so that they can run numbers and say, if you do nothing, this is what you're going to owe, which is, for everyone who didn't raise their hand, that's what you've been doing. But ideally say, do X, Y, Z, some of the things we're going to talk about today, so that instead of your tax bill being here, your tax bill can be here, so that your income goes up and your tax bill stays the same, or even better, goes down. And so if you're not meeting with your accountant throughout the year, then you're probably leaving some money on the table with that. And then another really important concept around kind of your numbers and accounting is actually keeping up your books. Who loves doing their books? Anyone? No hands that time. But doing your books helps you actually, number one, run your business effectively, rather than kind of opening up your bank account in the morning, and if there's money in it, you spend it, and if there's not, you don't. You can actually look at your numbers and say, here's our profit margins, here's our cash flow, you get an understanding about your numbers. And your books also help you save taxes, because if you just do your numbers by an Excel spreadsheet, or just kind of you make up the numbers and send them to your accountant and they all end in 3 zeros, they're all round estimates at the end of the year, then every dollar you miss as a deduction in your books is at least 30 to 40 cents going to Uncle Sam. So if you miss $10,000 of expenses because you're not reconciling your books, that's $3 or $4 grand that you're just sending away in unnecessary taxes. So doing your books helps you run your business better, and it helps you actually save taxes. So it gets a little sexier when it saves you taxes. So that's kind of just a couple high-level notes on tax planning, and I got my little notes I want to make sure I want to cover here. So the next is going to be entity selection. So getting the right entity type can make a huge difference, and then even within that, once you get in the right entity type, setting it up the right way. So who here is an S corporation? Just to get and C corp, single member LLC, or sole proprietorship? Okay. So for the most people that are running a small business, they want to be functioning as an S corporation. Unless there's a partnership and they don't have there's not a non-USA resident or citizen as an owner, or some reason that's making it so they can't be an S corporation. Most of the time you want to be an S corporation to save something called self-employment tax. So what self-employment tax is, my handwriting is like a doctor's, so bear with me. No offense to the doctors in the room. Okay. So what self-employment tax is it's 15.3% on the first $170,000 of your income on top of income tax. And so what it's essentially funding is it's your Social Security and Medicare for you as a self-employed individual. So if you ever had a W-2 and you look at your pay stub, well, what your salary is isn't what you're taking home, right? So there's an amount taken out for income taxes, and then Social Security and Medicare. Well, that Social Security and Medicare is about 7.5%, and then your employer would match that and send 15% into Uncle Sam in the form of payroll taxes. Well, when you open your business, there's no one to withhold that 7.5%. There's also no one left to match the other half. But guess what? Uncle Sam still wants his 15%, and that's on the very first dollar. So S corporation profits are not subject to self-employment tax. And the bone you have to throw the IRS if you form an S corporation is you have to pay yourself a reasonable salary. Now, reasonable salary is going to vary from business to business, but let's say just for simple math, you were profiting $170,000. It turns out we can have you pay a $60,000 salary. So instead of paying the 15% on $170K, which works out to be about $27K in self-employment tax on top of income tax, you can then pay the 15% on $60K, or about $9,000. So just doing that right there saves $18,000 on taxes. Now it's got to be reasonable, and why this is kind of nifty is because the way that Social Security works is on everything past a wage of about $50,000, less than 15% of your payroll taxes are going into your actual Social Security bucket. The rest is going into the Uncle Sam kind of fund, or the people that are making less. And so by doing this, you don't lose your Social Security and Medicare credits, but you pay, but you save a lot of taxes. And then you just take the rest out as a distribution. And the other cool thing about an S corp versus a sole proprietorship or single member LLC is you're about 10 times less likely to get audited. So as a sole proprietorship filing or single member LLC, you have about a 2.3% chance of getting audited. As an S corp, it's 0.2%. And that's because it requires a more advanced auditor, and they let them all go in 2008, and they've had a hard time bringing them back, and now they're laying off a whole bunch of all the new people, so it's probably going to even go down even further. So when you do that, you can get a little more aggressive on all the other tax planning strategies, because and we're not saying do things illegal, but just you can be more aggressive because you're less likely to get audited. Yeah, so if it's real estate only, you don't want an S corp in an S corp. That's the one. This is actively managed business would go in an S corporation. For real estate, you don't want it to be in an S corporation because there's a rule that says if more than 25% of your gross receipts that are in an S corporation are passive, then you lose your S corporation. Then it reverts to a C corp. And then you have all the value of real estate trapped and it creates all kinds of bad things with that. So that is the kind of the one thing is if it's real estate, then LLC is usually the better way to go. That's fine. So same thing. So all S corporations are born as either an single LLC or a C corporation, and then you just make the tax election. So it's the same audit rates if you make the tax election as an LLC S corp versus a C corp S corp. Same thing. On exit, it does make a difference on that in terms of what they're paying, because with a C corp, you have something called double taxation. And so with the C corp, you have, let's say you make $300,000. Right now, the corporate rate is 21%. So you got $63,000 in corporate tax, and then when you pull the money out personally, you pay tax at whatever bracket you're in on that $300,000. And so you get hit twice. So this double taxation is no fun when you're earning income, but then when you sell the business, you have all of those gains at the corporate level. And then when if you sell it for $5 million, you probably want to take that money out to do something with it. Then you've got personal tax on that side too. So there's certain structures. Number one, if you've got to be an S corporation, every owner has to be a U.S. resident or citizen, and then you can only have up to 100 shareholders. And so if for some reason you don't meet either of those criteria, then it can make sense to be either a C corp or an LLC taxed as a partnership. Also, if you've got multiple owners with an S corporation, distributions have to be proportionate to equity. And so if you've got silent investors that just want to wait and sit and leave the money in the business and have a cash payout on an exit, but they don't need the money, whereas the operator of the business is wanting to take distributions out, then you may want to be either LLC partnership or C corp at that point, because you're taking money out at different rates. And so those would be the times when you would see that. The other time you see a C corporation is there's sometimes in like these kind of multi-tiered entity trust setups where you have a C corp over here, and if you've got a lot of medical expenses, You can set up a medical reimbursement plan in a C Corp and deduct your medical expenses from the very first dollar rather than having what's called an AGI limitation on your Schedule A. And that can be better than, so like an HSA, for example, a health savings account. If you've got a high deductible health insurance plan, you can set up an HSA and put up to, I think this year it's $8,500, and take a tax deduction when you make the contribution into that, and then use it to pay your medical expenses from. So then you get to take the deduction when you make the contribution, and it's tax-free when you pay the medical expenses. Rather than if you just have just a normal out-of-pocket and you go and pay your copay with your credit card, you total up those medical expenses, it's subject to a 7.5% AGI limitation. So let's say your income is $100,000, you don't get a dime of tax benefit until your medical expenses reach $7,501. And so you can get more benefit on the HSA, but if you've got more than $8,500 of medical expenses, like say $30,000, $40,000 a year, because either like there's like an IVF or someone gets real sick, then it can make sense to possibly set up a C Corp and do a medical reimbursement plan in those kind of unique scenarios. So that's another time when you see a C Corp. Well, you can change it at any time. You can change it from month to month. For auditing purposes, what they care about is what is the final number on your W-2 that goes on the officer compensation line on your S corporation tax return. And really what that reasonable compensation number is it's if you had to hire someone to replace the activities you're doing in the business, not owner activities, but activities you're doing in the business, what would you pay at a market rate salary for that? So kind of good tax planning around reasonable comp is figuring out what is your day and week composed of, and how many hours of that is like owner activities up here where you're getting the profit benefits versus in the business activities of doing the thing in your business. So if we can prove and document that you're only spending 10 hours a week doing the main activity in your business that might in a full-time salary be $120,000, then you can say, well, your actual comp for that is $30,000. That's just a example because you're 10 out of 40 hours a week, 25% of 120 would be so the good planning with the S corporation is how do we get your reasonable compensation as low as justifiably possible. So you just take a distribution. You don't want to do a bonus through W-2. Yeah. Well, but I've seen people where they actually run it like a bonus, where they pay themselves a W-2 at the end of the year, and then they're just wasting the benefits of the S corporation. Yeah. It's better if there's at least some sort of fixed monthly salary because you want to treat it like actually paying yourself. But all right, next thing I want to talk about is something called the Augusta Rule. Anyone heard of this? Yes. Cool, a couple people. It's named after, so this is a rule that says you can, if you own your home, you can rent it up to 14 days per year, tax-free. It's called the Augusta Rule because every year when the Masters Golf Tournament, it just happened, comes to Augusta, Georgia, everyone who lives there, actually Court and I just went and we were there, we were talking with one of the employees who literally was doing this. So they rent out their homes and because they can get a whole bunch of money for doing so. And like this gal that we talked to, she has a trailer that she just pops in her parents' driveway and stays there for the whole week because they can get like 50 to 100 grand renting out their home for a week and it's tax free. So how you can use this in your business is if you've got a home outside or an office outside the home, you hold a monthly shareholder board meeting at your house and rent the house out to your business for the use of that meeting day. And so then you just cut a check from your business account, so business account to your personal account. It's deductible as rent expense here, and it becomes tax-free rental income over here. And so kind of a couple keys on that is you got to make sure that you have a rental agreement in place between yourself and your company. And number two, you want to document what was discussed and decided on at that meeting. It works really well if you have a split personality. I don't know if you're like me, I'm arguing with myself about what I do in my business all the time anyways. And you want to charge a reasonable amount for rent. So that's usually between like 0.1 to 2.2% of the value of the home. So if the home's worth $1 million, kind of $1,000 to $2,000 a day in rent you can get away with. And I know that doesn't buy a whole lot around here. But let's say your home is worth, $1 million and you've got $2,000 a day times 14 days per year is 28 grand tax-free. Put about 8 grand a year in your pocket just for cutting a few checks. And what I like to do is it's very easy for, everyone's busy, life gets busy, business is busy, and it's easy for suddenly 5 months to go by and you forgot to, cut your checks. If you just go into your bank account, and if you've got your business and personal accounts linked, then you just schedule out the transfers to happen automatically at the 15th of every month, and you just make sure that you're having your board meeting around that time, and then you get tax-free money out of your business. Comps, so best practice, if you're like, grade A's, straight A's student on this, is you find a couple conference rooms in the area that are similar size to your house, call them up, find out what they're charging for a day's rent, and kind of take the average of that. And I've done that, and it usually works out at about 0.1 to 0.2% in most cases. But full documentation, yes, that would be like best practice. What's nice about this is rent expense isn't really an audited expense line that they're going after. And especially if you've got, as a percentage of your business, if it's very small, it's not going to be something even that they hardly look at, but that would be great documentation. Now, if you're doing 50 grand a day and trying to take 700 grand out of your business, then you got to justify that. Have a little more documentation versus $1,000 a day or something. So that would be helpful, but I would actually say the more helpful documentation in comp would be what are conference rooms going for, or an Airbnb for a night of a similar type of home. It's like the market rate for renting it out versus the market rate for buying it. Does that make sense? So yeah, that's Augusta rule. Yeah. So yours would be you're paying earned income. You're paying tax on your salary portion, right? So let's say it was 100 grand total, and 10 grand of that was for rent or for a portion of your stipend, whatever. Instead of paying tax on 100 grand, you'd pay tax on 90, and then you'd take 10 grand and report it on a Schedule E that's tax-free. So even though it's not business income, you are paying tax on that portion of it. So yes, that would absolutely be something. You just change the structure of your compensation, and they pay you, a different amount, $1,000 per month or whatever that might be for rent for the use of your house. It just has to be less than 15 calendar days per year. The second it hits the 15th day, then it's all taxable. And so that's where if you rent your home out a couple weeks, or you put your home part-time on Airbnb, if you're snowbirding or something like that, then it wouldn't work if you're over the 14 days. Yeah, so do you get interrupted while you're at the office ever? Yeah, so out of the office, distraction-free time to plan for the business, reflect, make decisions, figure things out strategically. You just have a Word document or Google Doc or a journal, or you just write down, your agenda. Like if you have a planning day that you do, and you're looking at the last month's numbers, figuring out next month's goals, deciding to hire another, admin, or you're making decisions all the time. Now you're just writing them down on paper and documenting that you had those decisions made during a strategic meeting at your house. So I have what we call the grin test. And that is, if I'm an auditor and you're sitting across the table and I ask you what this expense is for, you got to be able to look at me in the face and tell me what it is without grinning for at least 60 seconds. And so it's kind of that, like if you're holding a full Zoom meeting with your team and you're the only one in your office, or you're the only one at the house, I would say that's not a business reason to get to the house. If you've got an office that you need to get out of that environment, to get clear-headed, or you're hosting employees over at your house for a team dinner or something like that, then those would be, when it would make sense. No. Just up to 14 calendar days in a year. So that's what I like to do is once a month, and then bonus mid-year, you do a 2-day planning day, and then bonus at the end of the year, you do a 2-day annual planning. All right, who's got kids? Who has them on the payroll? All right, we got one. All right, good. Over 18 kids? So everyone's, okay, perfect. So you're going to want to get them on the payroll. So the IRS has a rule that says you can pay your children, well, anyone can earn, because of the standard deduction we talked about, up to 15 grand a year and pays zero income tax on that at the federal level. We don't have to worry about state taxes because we're in the great state of Florida. And the IRS has another rule that says if you pay your under 18 children, under 18, from a sole proprietorship, then they are exempt from payroll taxes. And so that's about 15% of whatever their wages are. So you hire your kids, you hire them to do something, whether that's help you with sales calls, help you with if they're teenagers, they can help you get your TikTok live, or they can help with admin stuff, and you pay them, and it's up to $15,000 a year tax-free. And just a bit ago I said don't be in a sole prop, be in an S corporation. So what you want to do is say you get your S corp, C corp, whatever. You open up a sole proprietorship family/talent management company, transfer the money from your business account to your personal account because you are the sole prop in the eyes of the IRS, and then you open up an account in the kid's name and then pay them. And then from there, they can now buy their own clothes, buy their own groceries, their own Christmas gifts. Are you full W-2 or do you have a business? So I suppose you could, because first I'll say the Roth piece just for everyone, and then we can kind of talk about that a little bit. So what's really cool about this is it's earned income, which means you can contribute up to, I think it's $7,500 in 2025 into a Roth IRA. And normally Roth IRAs you put in with after-tax dollars, and then the money grows tax-deferred, and then it's tax-free when you pull out in retirement. In this case, you have tax-free money that you're putting into a Roth, and then it grows forever tax-free, so you can set them up. We'll talk about a legacy. And then if they decide they want to go to college, they can actually use that money and not pay the early withdrawal penalty on college tuition or a first-time home. There's a lot of flexibility with that. But you take your tax-free money, maybe all of it goes to Jupiter tuition, but if there's any left over, then you can put money into a Roth IRA. So for them, the goal is to kind of put money into a Roth. Is that the goal? The trick I would have with that is, what business are you paying them from to have that be earned income? It would have to be some sort of, whether it's a side hustle or a portion of your income is 1099 because it's separate from your main W-2, from your, something like that. If you had some sort of 1099 income that you could then write off the what you're paying them from, then yes, you could do that. Otherwise, it's kind of tough to justify that you're paying them a job for a business that earns money for a business. Yeah, and you're only getting a tax ID number for this. You don't need to set up a new big LLC or anything like that. You just need a tax ID number so that you can issue them W-2s and file payroll tax reports. Because that's one of the big kind of the I's to dot and T's to cross and all these things. Like with the Augusta rule, it was have the rental agreement, pay a reasonable amount for rent. With this one, they got to do something that justifies the wage. So you can pay them more than 15 grand if they're older and they're doing something that you would pay someone 40 grand a year for. Just the 15 grand is what's tax-free. And then the next amount, it might be an 8% tax instead of your 35% tax. So you still get a savings on that. So it's got to be a reasonable amount based on what you pay them. And then you've got to actually pay them into the kids' account here. And then you've got to issue payroll tax reports and W-2s to them. So we've had court cases on these where they've been audited and lost. And anytime that happens, they're writing it off by journal entry. And they just make a journal entry in the books and say, I paid my kids. Where it gets held up is when you do all those other things that I just mentioned. People love doing business with a family man. Hire them as models. Put them as pictures on your website, your social media. I'm serious. So when I do consultations with people who come to me from following me on Instagram or wherever, and they're like, oh, I love you. I see your kids and stuff that you do on social media, and they feel like they already know, like, and trust me. So there's a business reason behind it. Now it might not command 50 grand a year. The cuter the kids, the more you can justify charging. So I'm out. Most people's kids are pretty cute in their eyes, right? So yeah. That's if they're under 18. If they're over 18 and they're going to college and they're still a dependent, you can set up a new entity, an S corporation that's like, say, a marketing management company if you have them help with your social media, and you pay them, let's say you can get up to $30,000 to $35,000 a year tax-free by paying the S corporation there, and you pay them a small wage so that they have some earned income. And then now, if you're in a situation where this makes sense to do for you, you probably make too much money if you claim them as a dependent to take the education credits, so you lose the education credits. Now they claim themselves, and they have this $30,000 to $35,000 in income, plus the $15K standard deduction, plus $4,000 in education credits that you phased out of or lost anyways. And so you end up being able to get about 30 to 35 grand a year tax-free if they're in college. You can also do this with if you have like special needs adults or parents that you support, that you can have an entity that they own passively, and you can funnel some money into that to kind of plan if you're already supporting them and will be kind of adult dependents. Sorry, yeah. No, these are all just business deductions. So if you're a single member LLC, so you can do all this same stuff? Okay. If you're in real estate, is it like an actively managed? Okay. Do you have like a management company that manages them all? So you may want to form a management company and have all of the rental properties pay that management company, and then you can do some of this stuff. But what you want to, that would be your S corporation. But you want to make sure that whatever you have as an offer, a reasonable salary and all of that, that's subject to the 15%, that the tax benefits you get from doing all this other stuff is greater than the annual tax prep fees from setting up the new entity and the 15% self-employment tax. If you're just in real estate, sorry. So have you ever heard of a thing called the cost segregation study? Yeah, it's a great way to accelerate depreciation. And you take bonus depreciation on about, So that's a major planning opportunity there. It's accelerating the deductions forward. All right, so you've got your business. You set up college, S corp, marketing company. Handwriting gets better and better. So then you go call it 30K here, and then they have to have at least 50% of their own expenses through earned income, through a wage. So, and I'm getting super granular here, but you've got to pay them like about a $7,000 to $8,000 wage to make sure that otherwise it's taxed at your rate. So you do that, 7 to 8K wage, and then child gets 4K credits plus 15K standard deduction. You good? More kids. I had one client that came to us, he had 9 kids. 9 kids. So you have to pay, they have to have some salary, otherwise they become subject, if they're 23 or younger, they'd be subject to the kiddie tax rules, which means if all their income is passive and they're under that age, then they pay tax at your rate. So that's why you get around that by having them earn a wage. Now that can be working for Starbucks or the campus bookstore, then that's perfect. Then you don't have to worry about that piece. We just want to make sure that there's at least $7,000 to $8,000 of earned income in there. I know we're running out of time. Do we got two minutes? Are we good? Travel, you want to hear about business travel, how it works? I'm going to probably fly through this even faster than I've been flying, but make sure you get this. So here's how business travel works. We've got hotels, meals, flights, pretty much as your travel expenses. So you count up the days, and if you're doing a trip that's business and personal, you go on vacation and you're also looking for a new office location to open up. You total up the days that are business days compared to the total trip, and if it's over 15% or over 50%, then the flights are 100% deductible. If it's under 50%, then the flights are 0% deductible. So timing and how you figure this out matters. And the hotels and meals are based on the percent of total business. So if you're traveling for a week, 4 days are business, 3 days are personal. Flights would be 100% deductible. Hotels and meals would be 70%, roughly, whatever that number is. But the IRS has a rule that says if you have business on Friday and then business the following Monday, then Saturday, Sunday count as business days. So the difference between flying out Monday, a Monday to Saturday trip, where you fly out Monday, you work Tuesday, have fun on Wednesday, work Thursday, have fun on Friday, and then go home. That trip is 2 out of 6 deductible, so it's 33%. So only 33% of these deductible, none of the flight is, right? If you fly out instead, fly out Thursday, work Friday, have fun Saturday, have fun Sunday, work Monday, have fun Tuesday, and then fly home on Wednesday. Now suddenly, it is only 1 day out of the 6 is personal. And so now it's 83% of the hotels and meals and 100% of the flights, just by shifting your travel dates forward a couple of days. So that's those are the little things. And like if you travel a lot for work and pleasure with your spouse, if you're bringing along your spouse, their flights and meals aren't deductible. If you're bringing along an employee, they are. So you get your spouse get your wife on the payroll and pay her $500 to $1,000 a month for helping with I'm sure you have emotional support, consultation, whatever that might be. And then now her flights and meals are deductible as well. And then on the retirement planning side, you can also max out whatever retirement plans you've got. That's fine. So that's fine. And in your case, what I would look at traveling, if you're ever traveling to actually look at places, document all that and total up those expenses. And then when you go to actually buy a place in that area, that can count towards your basis on the, yeah. So for receipts, what I like to do is just take out the phone, take a picture, it uploads it to the iCloud, and then on the date, as long as you take the picture of the receipt on the date, you don't need to put it into some fancy receipt tracking system or anything, because if you get audited, you can go and they say, what was that expense on April 30th? You just go scroll to the date on your phone. Here it is. It's pretty, that's the easiest. Yeah. So restaurants for meals, you need 5 things. You need the name of the restaurant, the date of the meal, the amount of the meal. Those 3 are on the receipt. The other 2 is who you met with and what was the business purpose. So what I like to do is when you get your check and you're filling out the tip and signing it, you write down those two other things right while it's fresh, ready to go. Take the picture and leave it at the table. You don't have to shove it in your pocket. It goes through the laundry 4 times and then it fades away and all that. So yeah, so that's, and then as far as the documenting the business purpose, while you're on the plane, just pull up a Google Doc and say, I looked at XYZ properties, or I went and looked at this location as a new location, or it's a retreat, so I'm getting away to do some planning in a different area or whatever that might be. It depends on the auditor you get. I always say, especially these days, they're getting more aggressive because it's so easy to take the picture. And a perfect example, if you get an aggressive auditor and you might think, okay, every time I fill up at the Shell station, of course that's going to be fuel for my business. Well, an auditor might say, well, hey, there's a Quickie Mart attached to that Shell station. How do I know you didn't go buy a couple cases of beer on that receipt for those $60? And so if you just print the receipt out, take the picture, then you're good to go. It's a little more documentation for a lot. Once you get in the habit of doing it, there's not a lot of effort. Yeah, you can do that too, and they'll add it and categorize it. But it's a lot better than shoving them into a shoebox in the corner of your house or your office. And I know we're out of time, so thank you guys for listening, and hope you got some value out of it. Yeah.
Awesome, Tyler. Thank you.
Yeah, of course.
Helpful.
Yeah.